You mentioned about how retail might actually not do what they should be doing. What would you have retail do? Should investors by and large continue the systematic investments that they have been doing? Should there be focus towards maybe smaller and mid caps as opposed to large caps, because the valuations have been bombed out a lot more than large caps? What would you have retail do?
I think the SIP part continues, right? So I think SIP investments are always a sensible way of approaching the markets. But I think it doesn't stop there, right? SIP is an integral part of a strategy, but it has to be enhanced, I think, over a period of time with occasional lump sum investing. And that lump sum investing is ideally suited in an environment where markets are correcting and when markets are cheap. And those are markets which are the hardest to invest in. So typically a retail investor puts lump sum in at the wrong time, when markets are doing particularly well, when news is good, and when it's easier to make that investment. So my advice would be to always continue with the SIPs, but look to enhance that by putting money into markets which are depressed. And eventually we will always normalize from that kind of depression. And when you invest in cheap markets, your returns get enhanced. So I think a combination of SIP with sort of occasional lump sum investing is the right way to approach markets. But it's difficult. The SIP bit is a little bit easier because you're investing regularly and you don't have to watch the ticker and your portfolio NAV as regularly. But I think the lump sum bit is important. And I think, when the market's expensive, it doesn't make sense to buy into corrections. But now we're in an environment where the markets are reasonable. If we correct from here, we will approach some degree of cheapness. We won't get to great cheapness, but we will start approaching cheapness as we correct from here. So I think, lump sum now should be on the horizon. At least it's something to be considered at every dip. And I think the trick here with lump sum is not to do it in one shot, right? Because, you don't know where the markets are going to bottom. So to do it a lump sum, even not on an SIP basis, but a regular lump sum, in the sense that at every dip you put in a little bit of money, and that way you typically catch reasonable valuations.
On the argument of large versus mid and small?
I don't think this is, I think we have to move past this debate. I think every portfolio, markets rotate, right? And this is an integral part of how the market behaves. Market rotates between sectors, styles, themes, market caps, right? Now, the typical investor wants to capture one theme and run with it till its very end, right? So when large caps are doing well, only large caps, mid caps are doing well, only mid caps, and value, only value, growth, only growth, and so on. I think we have to have a much more balanced approach, right? So depending on the investor profile, you can have a sort of 60-70% in large cap and sort of 20-30-40% in mid and small. You keep that roughly static with a little bit of an adjustment, little plus, little minus, depending on how the environment is. An environment more positive for mid caps, you top up mid caps, maybe reduce a little bit. But I think this extreme movement just in one direction or just in the other direction, I think that's something which is very difficult. We keep telling investors it's very difficult to time the market. And then how can we go out and step out and say, time the market and put it into mid caps and put it into stocks, put it into X, Y, Z. So I think that's always it's fraught with risk. I think we have to have a more balanced approach. I think one must always have large cap, mid cap, and small cap. You can adjust it depending on your view, but being only in one category or another category might mean that you lose out on potentially large returns.